Welcome to Books in Sum, your go-to for bite-sized book summaries.
Black Edge by Sheelah Kolhatkar. Steve Cohen is a billionaire Wall Street investor who got his start by illegally obtaining black insider information on the financial performance of companies. He was a gifted trader who enjoyed early success, but he was accused of engaging in insider trading. In 2008, while U.S. federal agents were working to bring down Wall Street tycoon Raj Rajaratnam, an intriguing discovery was made. Cohen, a gifted trader who enjoyed early success, was accused of engaging in insider trading. Cohen was born on Long Island, New York, in 1956, and he grew up in a middle-class family. He was captivated by business and finance news, so he regularly checked the stock market and read the Wall Street Journal. He also made a lot of money playing poker, at which he excelled. Cohen has avoided incarceration despite facing multiple criminal charges. David Cohen started working for Gruntle & Co., a New York investment firm, in 1978. He was wealthy, making between $5 and $10 million a year, but he was accused of insider trading. In 1985, the SEC investigated Cohen's dealings and discovered that he had benefited from inside information about General Electric's plans to acquire electronics giant RCA. Cohen founded SAC Capital, an investment firm that actively sought confidential information. In just 14 years, Cohen rose from the ranks of junior traders to become a household name on Wall Street. Cohen started his own successful investment firm, SAC Capital Advisors, in 1992 and has been reaping the rewards ever since. SAC's initial investment of $50 million in 1994 quickly multiplied to $100 million in 1997 and then to over $1 billion by 1999. Cohen attempted to systematically receive and trade on inside information, betting on short-term fluctuations in stock prices. As a result, Cohen began seeking out and employing traders who possessed a fundamental edge, defined as in-depth knowledge, expertise, or personal connections within a given industry. In 2006, companies such as BioVale and Fairfax claimed that SAC Capital had manipulated their stock prices by spreading false and negative information about the company's performance and business practices. Managers at SAC Capital advised their traders to network with influential people in order to learn about upcoming developments in advance of public announcements. Investors were linked to company heads via expert networks like Gerson Lehman Group. Almost 5 million people in the United States have Alzheimer's disease. In 2008, SAC used research into the disease to profit from massive insider trading. Even though the SEC and the FBI knew the accusations were false, they still took note of them. SAC's strategy entailed wagering on short-term fluctuations in stock prices, such as those that occur after news of company earnings is released. Matthew Martoma, a SAC trader, was curious about the efforts of Elon and Wyeth to create a treatment for Alzheimer's disease in the 2010s. He became close with Dr. Sid Gilman, chair of Elon's Safety Monitoring Committee, who oversaw the development of BAPI. Martoma prodded Gilman to reveal SAC's highly successful confidential BAPI trials. Martoma realized that BAPI was a dud as an investment opportunity right before the final test results were set to be released at the International Conference on Alzheimer's Disease in Chicago. So he called Cohen and they agreed to quietly unload their stock. Martoma and Cohen made a cool $276 million when the share prices of Elon and Wyeth plummeted after the BAPI results were officially released. U.S. regulators began cracking down on insider trading in the late aughts, and SAC's entire business model rested squarely on the integrity of its intel. The FBI and SEC secretly began their investigation into SAC's business practices in 2009. The FBI tracked down former SAC junior analyst Jonathan Hollander, who had traded stock in supermarket chain Albertsons after receiving insider information about an impending takeover from a friend. Before the results of the BAPI trials were announced, the SEC began looking into SAC's spectacular success trading Elon and Wyeth stocks. Matthew Martoma, a trader at SAC Capital Advisors, and Dr. Sidney Gilman made headlines in the United States in 2011. The U.S. government finally made some headway, and both Dr. Sidney Gilman and Matthew Martoma are now suspects. Months before, Gilman was named by the SEC as the likely leaker of BAPI trial results, but the identity of his contact at SAC remained unknown. After subpoenaing Dr. Sidney Gilman's phone records, the SEC was able to trace a suspicious number to SAC portfolio manager Matthew Martoma. It was also revealed by the investigation that Martoma had made contact with Cohen prior to the SAC sale of its Elon and Wyeth shares. After Martoma's arrest in late 2012, SAC paid a then-record fine to resolve insider trading allegations. Gilman was able to recall every fact about the BAPI trials when questioned about the science behind them, but he stonewalled investigators when they asked him about his connection to Martoma. Martoma, who was facing up to 10 years in prison, claimed the Fifth Amendment protection against self-incrimination. Gilman's decision to fully cooperate with everyone came in August of 2012. Cohen admitted to sharing confidential BAPI test results with Martoma, but the FBI still had enough evidence to arrest him. Cohen was alert to the risk, and SAC agreed to pay a staggering fine of more than $600 million to resolve the insider trading cases. Despite the SEC's desire to press charges against Cohen personally, SAC settled for a second fine, and Martoma received a prison term. The SEC was able to obtain an email that may have linked Cohen to additional insider trading at SAC. Mike Steinberg, a SAC trader, learned of Dell's disappointing business figures in the summer of 2008 and used this information to bet that the company's stock price would fall. In addition, SAC agreed in July 2013 to pay a record $1.2 billion fine to settle this case. The SEC intended to use this evidence to find Cohen guilty of insider trading. Steve Cohen was found guilty of insider trading after he sold Dell stock after receiving an email from Steve Steinberg. Cohen's attorneys said their client probably never saw the incriminating note because he only reads about 10% of his 1,000 daily emails. After settling with SAC for $1.2 billion, the SEC decided to abandon this line of inquiry. Matthew Martoma received a 9-year prison term, but he kept quiet and no charges were brought against Cohen. Since then, Cohen's wealth has increased exponentially, and in 2014, he renamed the disreputable SAC Capital advisors firm Point72 Asset Management. U.S. authorities have come up empty, and since then Cohen has made $2.5 billion. Cohen was a brilliant investor, but the foundation of his firm, SAC Capital Advisors, was corrupt due to its reliance on insider trading. While several of Cohen's traders were found guilty of insider trading, Cohen himself was never prosecuted. He's still making billions and working in the financial industry.
We hope you found this summary helpful in your listening journey. If you're interested in diving deeper into the topic or getting your hands on the whole book, be sure to check the description below where we've included links to the book and other related products that may be useful to you. Don't forget to hit that subscribe button to stay updated on our latest book summaries. And feel free to leave a comment with any suggestions or requests for books you'd like us to cover. Thanks again for tuning in and happy listening.